Hey, welcome back. I'm Joshua Bellinger of CounterVest. And if you're looking for a trade or you want to learn how to trade, you're in the right place. We're going to talk about an interesting and strategic way of catching a falling knife. And the one we're going to talk about today is a big catching knife. There's a lot of risk here, and we're going to walk through that. We're going to learn some mechanics, and we're going to walk away with a trade and how to manage that as well. So there's three things to a trade: thesis, structure, and risk management. So we're looking at Las Vegas Sands here, and as I mentioned, this is a falling knife. Uh, we've been seeing this sell off aggressively along with some other Chinese stocks, really China as a whole, because of what's going on in China with the government stepping into some of these sectors and industries. And also, there's a recent talk or recent rumors of a lockdown, and Las Vegas Sands has a lot of exposure to Macau. So right now, we're seeing that it just bounced off yesterday at 38.74. Now, last week, I saw put buying in this name and aggressive put buying, and I thought to myself, well, it's already been pretty beat up, and as you see here, it went lower. So one thing to keep in mind is when we start to talk about political risk and government risk, those are things that to be aware of. It's really hard to decipher, and it's important to know when you pick your spots and to manage your risk. And not saying that when you have to look for opportunities or find opportunities, I'm not saying that you have to, but myself, I'm involved in the marketplace. That's my job, is to figure out where the opportunities are, understand that risk, and how to manage that risk. So when I look at something like this, there are different things that we can use to understand of when it is right to step in and when it's not. Just because something is oversold, as we've talked about in different videos, we talked about EDU. Just because it's oversold doesn't mean it's a good trade. There are reasons why some things can be oversold, and every stock is different. When you look at something like Las Vegas Sands, is the government of China going to say no gambling anymore? Likely not. So that in mind, we can look at that. But we could also say that with the EDU or the private tutoring, that they wouldn't have done that as well, but they did. But that's why it's important to understand the risk and to how to manage it, to know when if something doesn't go right, to be able to walk away, come back tomorrow. So that's what we're going to walk through today. So with Las Vegas Sands here, one of the things that we want to look at is just because it was up today doesn't mean, well, everything's clear. We saw that previously it had 3 days and then had earnings and then sold off again. So what we want to see is that turn. We want to see things kind of turn a little bit to kind of figure out how to do that. Well, not kind of getting ahead of ahead of ourselves. What I'm looking for on this one, if that's the case, is where's the opportunity if I had to trade this or what there's different ways I find different ideas. This one is interesting because what I saw today was some call buying in this one. Now, some people may see this unusual call buying and say, wow, let's buy the calls on this one. Let's buy the calls. What if someone's buying the calls on this one, they are probably short and they're hedging. Now, it doesn't mean that it's not going to go up. They're just covering, they're just hedging their short position. That could, if there could be looking for a pop-up higher, which again is momentum higher. It's a pop-up higher, that's fine. Or they're just hedging that position because they're just managing the risk. Whatever the reason is, at this point they're a little concerned that prices may firm up and shorts may cover and pop up higher here. So one of the things that we want to look at, or when I look at this one, is where's the opportunity? The opportunity for me is not to buy calls, because when you buy calls, you're getting long, but the volatility, which you can see here, is going to go lower here. So you have a lot of headwinds in front of you, and it doesn't make any sense. If you're going to get long, it's just better just to buy the stock. So one of the things that I would consider on this one is a put spread. And the reason why a put spread specifically is I don't know if I want that risk. I don't know if I really want the risk of something happening. It's going to make things a little bit more complicated, but there's always a trade-off, and it's going to help just a little bit with that ease. Now, if you want, you could sell the 40. You could sell a put strike on this one, but if you want a little bit of, if you have a smaller account or you're a little concerned, that's what I would be looking for as well, because there is that risk, and typically if that risk wasn't there, what I would say is something on Las Vegas Sands or some bigger names that are very heavily traded or actively followed is that there's always an institutional bid. When things sell off, institutions are going to put money to work, and you always get a natural bid. That's why markets naturally go higher. That's why they're biased higher. When we talk about some of these China stocks, I think all bets are off. We could see that, but it's all bets off. So one of the things that you could look and use is an RSI, and we could see that RSI is oversold here, and it's oversold, and things can be oversold and overbought for a long time, especially if something's fallen. It could be oversold for a while, but it can help decipher when things start to turn, when that strength, that momentum behind it starts to fade off, and we could see that turn, meaning that there's no more sellers, and then all of a sudden the natural buyers come back in, or the covering comes in as play as well. So even though that we got this bounce off lower here, we did get into that level, and we're starting to get above it. So what I would like to see the next day, 2 days, is for prices to firm up a little bit, possibly get above this moving average here, which is the 10-day moving average. So here's what I have with all that in mind. We don't want to just step in right away just because things are oversold. You're going to take some heat. What we want to see is things kind of turn in our favor so we can sell and let that momentum go away. And we're selling that because we're going to let time tick away, and also we're going to take advantage of that volatility coming into play as well. Not buying the calls. We're not going to take that kind of shot. We're just going to let things pan out that way. So here's what I got. LVS. Going through the option chain here, what I'm looking at is I'm looking at the volatility structure. And one of the things that stands out to me is that the expiration with 22 days has a volatility of 61 overall. When you go 29 days, it has 54. Now, I'm interested in why that August 27th has a overall vol of 61. At first thought, I'm like, okay, well, that's where earnings are. Well, they just had earnings, so that's not the case. So there's a higher volatility in this expiration, which is interesting. That's what I want to take advantage of. So here's what I have. Here's what I'm looking at. I believe I already have it up here. So this is what I'm looking at here. What I want to do is I want to make sure that I get enough premium to make it worthwhile, and also to be able to manage. So what I'm looking at on this one, you have 22 days. You get a little bit of a momentum push, and you can sell this right now. It's selling at 63 cents for this specific one. I would be looking at something around the same thing, and what this is a 40, what is it, 40-25. So I'm looking at a 40-20-ish delta spread to sell that. Not necessarily on strike basis, but just on delta basis, because when you use options, you want to have a specific approach because options are messy, and the only way that you do that is you use deltas, things that are tangible that you can use to be able to create that consistency with an inconsistent product. So this is what I'm looking at right now. It would be the 40-38, $2 a risk, you take 63 cents in, and I would be managing this at, if I took 63 in, I would be trying to get 65, and I would take half of that. I would manage half of that. I wouldn't let this continue to ride because of that risk. So if, I'd be looking at something at 30 cents to buy that back. Now, it doesn't sound like a lot, and that's the trade-off here. That's the trade-off. You get a higher win percentage, and you get smaller wins. But that's a trade-off I'm willing to take, because I don't think prices are just going to shoot up unless some positive news comes out. That's fine if it does. I don't want that kind of risk. I just want to be able to maybe say to myself, hey, maybe it calms down a little bit here. While it calms down, take advantage of some opportunity to take some money out of the market on this specific position here. So that's what I have here. Now, there's all kinds of different ways to do this. It doesn't have to be necessarily a put spread. And when I walk through things with you, my stuff is a little bit more strategic. I would actually probably, if I took on a position here, if I saw something yesterday, or tomorrow, not yesterday, but tomorrow, what I would be looking for is I would actually probably try to sell something in the August contract. So instead of selling this 38 strike here, which you can see here is trading at 76 cents. If you see, you can fast forward here. If prices were just same price, fast forward, and with 8 days to expiration, you could see that 38 strike would be at 20 or 21 cents. I would sell this. I would get a bigger chunk out of it, and if I'm right, it pops up higher, so I have a bigger pie. Now this is where things can get a little tricky, and they will get tricky if prices were to continue to sell off here. I would be in a diagonal, and can make things a little interesting. But that's the risk. And there's different ways to manage that risk, but this is what I would be looking to do specifically. Or a simpler way is just to do the put spread. So that's what I have for you. Those are mechanics. That's what the steps you walk through. Now, you don't necessarily have to walk through it and go through every step like this, but once you get through the rhythm and you have chess pieces and so forth, this is how you maneuver in the marketplace, figure out your opportunities, diversify your risk, and then you manage that risk by taking profits. So that's what I have for you, and I will see you in the next video. Until then, good luck.